This is an Uncovered Japan company research report on eGuarantee, ticker 8771. eGuarantee is Japan's specialist trade credit guarantor. It protects corporate receivables, transfers most of the risk to financial institutions, and earns a spread through an unusually asset-light model. The research case is a real moat and high returns, set against a valuation that already recognizes much of that quality. At the report's reference date, eGuarantee traded at 21.4 times forward earnings and 4 times book. Those are premium multiples. They sit beside a 47% operating margin and a fiscal 2026 return on equity of 17.8%. The company is debt-free and capital light, but investors should distinguish a strong business from an automatically cheap stock. The product is easiest to understand as a workflow. A supplier sells to a customer and carries an unpaid invoice. For a fee, eGuarantee guarantees that receivable. If the buyer defaults, it pays according to the contract. Crucially, it does not retain all of that exposure like a conventional insurer. It transfers most risk to banks and funds, retaining only a minority. The result is an underwriting and securitization spread with far less capital tied up than a balance sheet-heavy insurance model. The core revenue identity is simple: guarantee liability balance multiplied by the effective guarantee fee rate. In fiscal 2026, revenue reached 11 billion yen, and the report models 11.9 billion for fiscal 2027. The balance actually driving revenue rose 9.9%, but fee rates have drifted down as the company wins larger, lower-risk comprehensive contracts. Volume must keep outpacing that rate compression for the growth engine to work. The long record is impressive. eGuarantee has delivered 23 straight years of record profit through fiscal 2026. Operating profit was 5.18 billion yen, and net income was 3.59 billion. But profit growth slowed as the cost of guarantees ratio rose from about 21% to about 27% when bankruptcies increased. This is the report's central operating watch item: whether the company can reprice enough to protect its spread as claims costs rise. The competitive advantage is not simply the guarantee product. First, eGuarantee has a proprietary credit risk database covering more than 300,000 companies and screens more than 30,000 a month. Second, it has a long-built network of institutions willing to receive transferred risk. Third, ecosystem relationships with Itochu, Teikoku Databank, and NTT Data support data, credibility, and client access. A new entrant would need all three layers at once to reproduce the same asset-light economics. eGuarantee combines high returns with a conservative starting balance sheet. The fiscal 2026 equity ratio was 68.8% and ROE was 17.8%. From fiscal 2027, management targets a payout of around 100%, alongside a 10 billion yen buyback program. The deliberate reduction of excess equity is meant to raise ROE further. The policy is shareholder-friendly, but part of the investment case becomes dependent on that payout and buyback continuing as planned. Management's Accelerate 2028 plan targets 20 billion yen of revenue and 20% ROE by fiscal 2028. Against fiscal 2026 revenue of 11 billion, that revenue target is a substantial step up from recent high single-digit growth. The report's base model reaches 13.8 billion by fiscal 2029, rather than a literal 20 billion target. The strategic flywheel is credible, but the numerical ambition should be treated as a management objective, not as an outcome already underwritten. The macro picture is genuinely two-sided. Higher bankruptcies make companies more willing to protect their receivables, increasing demand for eGuarantee's product. The same bankruptcies create more claims and higher risk transfer costs. Higher rates and credit digitalization have a similar mix of opportunities and pressure. The practical indicator to monitor is the quarterly cost of guarantees ratio. Its normalization supports the base to bull case. Persistent elevation makes the bear case more plausible. Valuation is where a high-quality story needs the most discipline. Compared with the closest structural peer, Zenkoku Hosho, eGuarantee earns a higher return on equity and grows faster. But it trades at roughly 21 times forward earnings versus about 12.5 times for that peer. Some premium is reasonable for faster growth, high margins, and shareholder returns. The report's caution is that the size of the premium leaves less room for operating disappointment. The report's 3-year scenarios are author estimates, not price targets or recommendations. From the reference price of 1,817 yen, the bear case is 1,155. The base case is 2,045. And the bull case is 3,045. The base case relies more on capital returns and steady execution, then on an earnings surge. The downside is meaningful if claims costs stay high and the valuation multiple compresses. eGuarantee is a rare Japanese specialist with a genuine underwriting data and risk distribution moat. Its asset-light structure produces high margins, good cash conversion, and strong returns. And the capital return policy is unusually shareholder-friendly. The offset is clear. At around 21 times earnings and 4 times book, the market already prices that quality. For the complete source-linked 5-part research series, continue with the free Uncovered Japan Deep Dive. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.